I'm James, and in today's video we're going to cover the income statement, also known as the profit and loss statement, or the P&L for short. This is one of the three major financial statements in accounting, along with the balance sheet and the cash flow statement. Collectively, these reports give us an impression of a business's financial health, so it's important that we understand how they work. An income statement is the summary of a business's revenues and expenses over a period of time. In its basic form, an income statement looks like this. It's a summary of a business's revenues and expenses over a period of time. When we take our total revenue and subtract our expenses from it, then we work out our profit or our loss. We make a profit when our revenues exceed our expenses, and on the flip side, we make a loss when our expenses are more than the income we've earned. This is why the income statement is also known as the profit and loss statement, or the P&L for short. It lays out a roadmap for how we ended up here at the bottom line, our profit or loss. The income statement always covers a period of time, which could be anything that we want it to be, but typically we run it for a month, a quarter, or a full year. Here's a helpful analogy. If a balance sheet shows us a snapshot of a business's assets, liabilities, and equity at a single point in time, then you can think of it as a photograph or a still frame taken from a video, whereas the income statement covers a period of time. It's like watching a clip of that video. It has a beginning and it has an end. And if we look at it carefully and analyze it, then it can tell us a story, but more on that later. Let's take a closer look at our income statement. Revenues less expenses make us a profit or a loss. The problem with this layout is that it doesn't give us much detail. It would be much better if we made things a little more descriptive. For instance, revenue. There are many different types of revenue. If we were running a business that sells physical products, then we might want to call this product sales instead. Or if we provide services, we could call this our services rendered. This extra detail helps the readers of the income statement better understand what they're looking at. Clarity is the aim of the game here. The same goes for expenses. Businesses typically incur many different types of expense, but broadly speaking, these can be broken down into two categories: our direct costs of doing business and our indirect costs of running the business. Our direct costs of doing business are the costs which we can directly trace through to the products we've sold or the services that we've provided. For a business that provides services, we might call this our cost of services. And if we sell physical goods, then we could call this our cost of sales or our cost of goods sold. Direct costs like these are variable costs, which increase in direct proportion to the sales that we've made. If you were running a retail or a wholesale business, then these would include things like the original purchase price of the product that you're reselling. Or if you run a manufacturing business, then this would include the cost of your raw materials or the direct labor cost that went into producing your product. As we make more sales, we incur more of these direct costs. When we take our revenue and deduct our direct costs of doing business, we get to our gross profit. If you're new to accounting, then you'll soon discover that we have many different types of profit. Our gross profit is a really useful tool that allows us to measure the efficiency of our production and sales process. I'll show you how that works in a minute. But first, let's jump back to indirect costs. These are the costs of running a business which can't directly be traced back to the production of goods or the provision of services. We sometimes call these overheads. Overheads can include fixed costs like rent, employee salaries, insurance costs, admin expenses, legal costs, accounting costs, marketing costs, depreciation, and amortization. Whew, there's a lot of them. Fixed costs like these tend to remain the same. They bear no correlation at all to the sales that your business has made. However, not all overheads are fixed. Variable overheads can loosely correlate with a business's sales, although they can't be directly traced back to the production of goods or the provision of services. These include things like advertising costs, which can indirectly drive sales, and sales commissions. Utility costs could also be considered a variable overhead in a manufacturing business because these can increase as we ramp up production. When we deduct our indirect costs of doing business from our gross profit, we come to our operating profit. Operating profit measures the net income that we generated from operations. This is the residual amount that's left over after deducting all of our direct and indirect costs of doing business. So this is our basic income statement.